everybody, and welcome to the next in our series with Ethan Chernovsky, the Chief Marketing Officer for Placer. And we are once again very happy to have you, Ethan. You've got a lot of great material, as you always do. And so why don't you dig right into it? Give us a little bit about your company first.
Amazing. So hi, everyone. Great to be back here. Just to give you a quick sense of who Placer is and what the data is you're going to be seeing in the background, what informs so much of our opinions, what we're going to be discussing today. Placer is a location data company. What that means in the simplest form is people vote with their feet. We're showing you how they vote across the United States every single day to retail locations. We do that by observing a panel of over 30 million devices. Very critically, this is all anonymized aggregate data, so we are GDPR and CCPA compliant. We then analyze that data with a series of different machine learning and AI algorithms in order to make estimations on visits to retail locations across the country. And we present that data in a wealth of different reports within our platform on everything from visit counts, true trade areas, traffic routes, and a whole lot more. If anyone is interested, we have a free version of our premium product at placer.ai. We also have free tools in a section of our website called Square. And I think with that, Robin, we can dive into it. And then also everyone, we're going to be taking questions. So please use the Q&A button at the top or bottom of your screen, depending on how you have Zoom configured, to send those over to us so we can get to them throughout the course of the conversation.
Thank you for that, Ethan. And what are the defining characteristics of the current challenges being faced? How are they impacting consumer behavior?
Yeah, so I think what's interesting is we come from this like extended period of COVID where there was a very specific type of challenge with a kind of a unique type of consequence. So it changed our behavior, but it changed our behavior in ways that we had become capable of understanding. So when we saw a spike of a different variant, the behavior was relatively expected. What's been interesting in the last few months is, we saw Omicron in January, and then we've seen this recovery since, but we are now facing a different set of challenges on the economic space. And that's these kind of wider economic headwinds from inflation to gas prices and more, alongside continued supply chain challenges, et cetera. What's interesting, though, is about these challenges that they have very different effects on how we behave from a consumer perspective. So if we think about inflation says the shop that we used to do at the grocery store, for example, that used to cost $100, now costs $110. And so what it's doing is it's raising the price of that visit to the grocery store. And so it can create certain types of behaviors. So as a result, I might say, look, $10 is annoying, but it's not the end of the world. I'm just going to pay it. It might also say if I'm at the edge of a bracket, let's say, I might decide to trade down and go to a more value-oriented retailer like an Aldi or a Lidl, a grocery outlet, etc. But it's about how do I maximize my spend? That's the question with inflation. With gas prices, it's different. It's actually impacting, do I leave the house? Is the cost of going out so significant that I, instead of taking 4 visits a month to the grocery store, I'm going to try and take 3? Am I going to focus on going to places that allow me to maximize my trip more significantly? And so what's interesting here is we have 2 different challenges that impact consumer behavior in different ways. And we're seeing those play out as kind of gas prices rose, we saw the impact. As kind of those costs of those core goods went up, we saw the impact. And so the question is, as these things decline, how long does it take us to recover into our former patterns? And a big element here is that we're not purely rational about these things. So if gas prices are starting to go down, which we're seeing signs that they are, that doesn't necessarily mean that the behavior is going to snap back, because we're not taking out a calculator and saying, all right, this is how much I'm spending on gas, this is how much I was spending on grocery, this is how far away grocery store X is versus grocery store Y, therefore it's worth it for me to go here. It has this lingering impact. And so I think we're going to see the effects of these elements beyond just their actual direct economic impact. And so there is a chance that we see the effects of high gas prices, inflation, even as they start to dissipate as time goes on.
Ethan, you do a very good job of clarifying a very confusing subject here, particularly with this inflation stuff. So what are the risks in trying to compare performance to previous years? Is there an ideal comparison to make here?
The answer is no, right? And the challenge with this is kind of it's exacerbating what we're dealing with right now, because we're looking at June and July numbers, and they're not what they were a year prior. But in some cases, they're still higher than what they were pre-pandemic. And in other cases, they're lower than they were pre-pandemic. And so what essentially the challenge is, how do we understand what we're comparing against? So when we think about year over year visits in right now, and we think about Target or Walmart, July of 2021 isn't a difficult comparison because it's a year ago. It's a difficult comparison because of how strong things were in retail. So we saw that reopening in June, these surges of visits, the back to school season, no international travel. There was a really big boost in visits to a lot of these top retailers. Now we're seeing that many of these retailers are seeing visits down year over year, but some of those are still seeing visits up compared to 2019. So when we look at the grocery sector overall, yes, things are not as good as they were at its peak a year ago in the summer, but they're better than they were in the same period in 2019. And so we have to try and balance multiple metrics to give us this picture of where we stand overall. So, take another great example for this is like the home improvement space. The home improvement space in the early days of the pandemic was surging to a crazy extent. And then the next year, visits were significantly down year over year. But that didn't mean things were bad. It just meant they weren't as good as that peak. And then a year later, we saw them down even compared to the period pre-pandemic. So it was like, okay, now are we seeing another effect? And in this case, we felt like we were seeing the impacts of inflation, basically saying, is this something you need to be spending on right now? So there's a large element of kind of rational thinking that's needed here. How do we contextualize this information? But also we can't get overly caught up in any single metric, and we need to look at multiple to try to give us this more holistic perspective on where things actually stand. I'll give you, and the reverse is going to be true soon. So we think about August 2021, visits were already starting to decline mid-month as the Delta variant rose last year. So are we going to see a rebound in visits? Does that mean things are really so different from how they were in July? Not necessarily. And so all of that context is critical. And the more we can consider all of these confounding factors, the better we're going to be able to understand where we actually stand vis-a-vis this wider economic environment.
Yeah, incredible. So what is defining the relative strength of certain retail segments, and do you expect it to continue?
So I think, there's obviously a lot of trend alignment when we think about sectors that are doing well. So you look at, discount and dollar stores, obviously outperforming many other segments. And that reason is I can get a lot accomplished in one place. So I'm not spending my gas money to do multiple trips. I can save money. I can accomplish more with the dollars I have. So it's accounting for inflation. There's other spaces. So we have that kind of trend alignment in this orientation towards value or towards, mission-driven shopping, trying to accomplish more with each visit. There's other spaces that kind of benefit from behavior changes. So we think part of the thing that has driven grocery visits is the fact that if a certain percentage of the population took on more cooking at home because of the pandemic, that doesn't necessarily go back to exactly where it was pre-pandemic. If this is this new skill set you've added, even if you don't use it as much, you might use it more than before. And so that's another element of like what behavior shifts are lasting and who do they benefit? And I think the last element is, do you think that these trends are going to continue? So when we look at something like inflation, this isn't going to disappear tomorrow. It might start to dissipate, but that result means there's likely going to be a lingering impact and a benefit given to certain types of retailers. Things like gas prices, we're already seeing decline. Do we believe that that kind of irrational lasting element will go longer? How fast will it decline? Will it decline significantly into the winter? These are all really significant questions that we need to ask to try to understand not just where consumers might be going, but what perspective they might have on the visit. So as an example, if I'm Target and I know that mission-driven shopping is a significant driving force because people don't want to make multiple visits, I'm building a lot of my marketing, I'm building a lot of my process in the store on ensuring that people know you can get so much done here and not have to make those other visits. Whereas if it's a pure inflation-driven perspective, maybe I'm emphasizing that, doorbuster mentality, we're going to be cutting costs, we have things at a value this year. And so understanding how those shifts might play out can go a long way in helping you strategize, not just things that, merchandising that you needed to decide months ago, but even the marketing campaigns that you can utilize, which have you can kind of deploy much closer to the actual events.
So Ethan, what is actually driving the challenges for these harder hit segments, and what can we expect from them in the coming months?
So I think what's interesting, if you kind of think about the restaurant space, is this ideal example of someone who's just through no fault of their own, they're not well positioned for what we're dealing with right now. We have less money to spend. And so are you going to spend it on a sit down restaurant, or are you going to kind of go QSR for that night out that your family needs? I think right now, the short-term economic headwinds are really significant for spaces like this. The question is, what are you doing to try to, one, mitigate the challenges, but also position yourself better for the long term? So we've already heard stories about how these shifts to better online ordering, curbside pickup, were huge benefits that can actually help minimize the damage, so to speak, of some of these challenges. But there's also this question of, where do we see a sector that is declining, but there's also a long-term issue? And where do we see a segment that's struggling, but it's clearly the short-term impact? So take home improvement as an example, or home goods, home furnishings, places where you would buy couches, things for around the house. We've seen really significant declines since inflation started to rise, since these gas prices started to go up. And there's this seemingly clear pattern of people saying, or a significant a marked percentage of people saying, this isn't something I need to spend on right now. But we still saw major migration shifts with people moving to different places. We still saw people moving from the cities into the suburbs with more space and more space to fill within these homes. And so the idea that the long-term demand for these sectors has diminished, in my mind, is incorrect. Instead, you're seeing a short-term speed bump on the way to long-term success. But there's other segments where there's something more challenging in a long-term basis, and therefore we need to kind of separate those groups to ask, where is there something fundamentally challenged to that sector or that retailer's long-term health? And where is there something that this is likely just, it's really difficult short-term, but once the segment kind of starts to once these economic headwinds start to dissipate, the success will continue as per before.
So how significant would you say are the wider retail struggles, and are there tactics to overcome?
So I think that the starting point is, it is a really difficult environment, and I think we need to come to terms with that, right? So, look at Prime Day as a great example. We saw in Prime Days past, we would see these big surges of visits, not just to Amazon, but also to the Targets and Walmarts and those who would kind of align with Prime Day. When we compare it to years past, we don't see those same surges. And so things are clearly very difficult, and they're very difficult across the board. But equally, these things still work. So kind of galvanizing and creating this customer urgency in the sense of, there is a reason for me to go out and shop today as opposed to tomorrow or in a month, still has an impact. And so when we think about those same Prime Day visits compared to the 5 weeks prior, we see big surges. And so I think we need to accept the fact that it is a very difficult environment currently because of the comparison, because of how good things have been, because of how significant these economic challenges are. But it's also not like retailers are completely incapable of fighting along in this situation. And we see some really strong ideas, and we see some kind of success. And I think elements like focusing on value are clearly going to carry the day. Being experience oriented. So it's not just a visit for 20 minutes, come in, come out, because is that worth the gas that I'm going to spend to go there? But how do I take advantage of what's around me to kind of sell this wider experience that you're going to get? I think that, and a clear focus on intent. Like, what can I do to get the right visitors in? And what can I do to give them an experience that maximizes their shop? Something is, like what Chanel's doing with kind of these, focused personal appointment locations. We saw Best Buy doing that in like the early days of the pandemic. Those are really successful strategies to help you filter out who's got high intent, and therefore giving yourself the service to the people who are likely going to spend more and maximizing those retail visits.
So Ethan, I don't think it's too early to, excuse me, talk about holidays. So how do you expect the current wave of challenges that you've been talking about to impact this coming holiday season?
So I think we're already seeing gas prices decline, which is great. And I think if that continues, that sentiment around high gas prices could be a positive thing. I think inflation is not going to disappear, especially not in the next few months. And so it's going to still weigh on people. But I do think that there's an optimistic viewpoint on this. And the optimistic viewpoint is we didn't get the full experience last year. October in 2021 was very, very strong. By November, things were already declining compared to that 2019 period because Omicron was on the rise and had, record case levels. So I do think there is still this element of pent-up demand for the holiday season. Plus, we're likely going to see a return of very value-oriented deals because there are retailers with excess inventory, because there is this inflationary period. And so the question is, what can you do to help incentivize that visit and then make that visit count? And as a result, I think we still could see a very strong holiday season, even in spite of the very significant economic challenges that we're facing.
Well, which brands and segments do you think are the best positioned to thrive in the holidays?
Yeah, so we're taking obviously a very bold position by saying Target's, going to do well.
Yeah.
I look at things like, Dollar General, obviously very well positioned, and even like home improvement, like Home Depot, especially when you're comparing it to a non-peak period. I think those are spaces that can do well, but it's always a question of where do you sit in terms of alignment with these wider trends. So if you have this one-stop shop offering, you're clearly at an advantage this season. There's also this upsell opportunity that comes with it. So if I'm going to Target because I want to get item X, but then walking through the aisles, I see 7 other things, that's a really powerful asset that Target has, where other retailers, I walk in, I get the things I want, but it doesn't have the same range, and therefore my basket size is going to be lower. I also think value is going to be a massive theme in the next couple of months in terms of how brands express what they have on offer. And so those who are oriented towards that are going to be well positioned. But then I also think there's this element of experience that matters. And so what are the places that you go that you feel the holiday shop that allow you to kind of satisfy this remaining pent-up demand, again, because much of November and December we didn't get to have last year. And if we see that pent-up demand start to play a role, and those brands that can tap into it and push that value orientation and push the fact of here's the things you can accomplish within that one visit to our store, I think you'll see a lot of really interesting returns. I'm really excited to see who kind of, like, I know we think about this as like that luxury level, but I have a deep obsession with this appointment shopping concept. Like, I want to see different brands say, okay, it's 2:00 on a Wednesday. Tell us the 6 things you're looking for, and we're going to be with you the whole way. Because in that way, you can bring in high intent visitors to low volume periods and start really maximizing that clock of when you're going to be open and that's the space you have available.
It's a great idea. So who might surprise us this season, Ethan?
So, I mean, I think it follows, I mean, it's not shocking, but it follows those same themes. Like, where are those places where I can get more accomplished with a single visit? It has that nostalgia element. And I'm well aligned with where things are going. So the starting point for us is indoor malls. The indoor mall holiday season experience is a pull. And part of the reason it's a bigger pull now is because you can do a lot in that day. So if we drive out as a family to go to the mall, to go shopping, the fact that there's the movie theater there, there's places to get lunch and food, there's much more experience-oriented tenants. So whether it's, I don't know, axe throwing for the more adventurous family, or, you know, something a little bit more low-key for those of us who are less keen on axe throwing, you know, that's a really big value add. And this idea that I can kind of check the box for that entire day, that 360-degree experience, is incredibly valuable. I think another group as kind of a second tier of that is department stores. I feel much more bullish on department stores than many. And a big part of the reason is because they provide a certain degree of efficiency of all of this stuff is in one place. I'm already there. How do I get more done? And then as the last one is movie theaters. And we've been calling this out for months now of there's a backlog of blockbusters. We've been stuck at home, so there's still this experience. And in something we learned in past periods of economic uncertainty, movie theaters provide a more value-oriented opportunity to get out and entertain the family. Does this mean that this sector is perfectly situated and like we should expect years of ongoing strength? No, of course not. They have major flaws that they need to fix. But in the short term, are they being given an opportunity to provide a very needed service at a good price point when there's a lot of good things coming? So it's not just 5 or 6 big movies, it's 10, 12, because we have all that backlog. I think it's a really well-situated segment to drive over performance in the coming months.
Well, you know, what about travel? I mean, they've been dealing with their own wave of challenges. And so what do you think, how could this impact holiday retail performance?
So I think international travel, having traveled internationally a few times, is not as pleasant as it once was. That doesn't mean it was super pleasant beforehand, but it's a mess at a lot of airports. And so the question is, are people going to say, I'll save the trip? Because if they say I'll save the trip, that could have a big positive benefit on retail. If this gets cleared up, I think travel coming back is something that we didn't have to deal with a year ago or 2 years ago. I do think there is a big question around domestic travel. So if international travel is posing a big challenge, but domestic travel has not been much easier. And so if we see declines in people wanting to travel domestically, I do think we're going to see a negative impact. If somehow domestic looks better than international, I think that could have a very positive effect on retail.
Yeah, and you know, so luxury, Ethan, it has been one of the strongest performing retail segments over the last year. Do you think that success can continue?
I really struggle with luxury because I think, you know, you have like, I think anyone who like looks at a space, you have that kind of chart of like, oh, I was right here and I was right here, and, you know, bravo, pat yourself on the back. And then there's the ones that you have to admit to yourself that you can't seem to get right. And luxury is one of them for me. And the struggle for me is there's very clear upside, but very clear downside. And every time I think one or the other is going to take over, I've been wrong. And on the upside piece, you think of the high intent visitor. So the people who are coming to buy, they have the money. You have kind of this excuse to shop because it's the holiday season, potentially the decline in international travel, the timing as things get a little bit better economically. Also very critically, the resale market. So the resale market is fascinating, and this is not my idea, I've stolen this from others, but the idea that $1,000 handbag can be resold for $700, if not more than the original ticket. It's not $1,000 anymore, it's $300. And so that high-end luxury is now much more accessible. And it's a different price point, which I think is really interesting for that space. But then you think on the downside, we have experiences back, we have eating out is back, we have kind of these wider economic challenges, we have travel coming back in a much more significant way than a year ago, at least. And so there is this lingering question of like, well, why do you have to make this purchase now? And if a portion of the population that was buying luxury is saying, look, I'm still in on luxury, but I don't need to buy it today. I can get it 2-3 months from now, or see what things are like in 6 months. That's going to start leveling out some of those positive factors. And so for me, this is really a toss up. My expectation is that we aren't going to see that luxury hit a really unique wave. It doesn't mean that if it declines, it's doing badly, but I don't know if it's good. I would be surprised if it reaches those same heights again.
Interesting. Luxury is always an interesting topic. It changes all over the place. Anyway, so DNB's digitally native brands, Ethan, went from the darling of brick and mortar retail to seemingly the punching bag. Is the DNB bubble bursting?
I don't think so. I think we have a tendency to get very excited about to get excited when we hear negative news, to potentially over exaggerate it, and then to double down on that, even though it's not necessarily fitting. So I think digitally native brands were kind of positioned as, oh my God, these are the smartest companies ever. Stores are so expensive. Who needs them? And then we kind of realized, wait a second, you do need stores. And they were coming offline. We're like, oh, these geniuses, them and their stores, and they figured everything out. They're data driven, and they're gonna take the world. The world is on fire. They're gonna do amazing. And then they face struggles. And I think part of the reason they face struggles is because their core online costs are rising. They're, as much as they're rolling out stores and they're learning and they're getting better all the time, they're not as experienced in running a retail fleet as brands that have been doing so forever. It's really hard to do. And, the challenges and the things they were able to get away with in the past because they were growing, rising brands versus those who are more, there's expectations and you've been around for longer and you have kind of a more ongoing brand relationship really matter. Like I have a colleague who talks about it often of how often are you refreshing your stock? If it's twice a year, that might not be enough to keep people constantly engaged as you're around longer. And it was like the iPhone problem for Apple of how, for the first few iterations, everyone wants a new iPhone, but then if I have an iPhone, do I need to get one every year? No. Is it every 2? Is it every 3? So understanding these new cycles that they need to deal with is really significant. At the same time, I think they have a lot of things going in their favor. And the first is they have an expansive view of what brick and mortar is supposed to do. They recognize that it's about eyeballs. They recognize that it's about marketing. They recognize that it's about distribution, taking in returns at a cheaper cost. And so their commitment to brick and mortar is not superficial. So I don't think they're going to back away from it. They might try to optimize it, but they understand in a really significant way, because they come from online only, why the store is so important. The other thing is it's about how they operate. So these are data-driven organizations that are constantly looking to test and optimize and evolve. And so yes, they might have a struggle, but that struggle doesn't mean something's bad. It just means, okay, we need to find new ways to optimize and do this better. And so I think this understanding that, look, these are really smart companies. They're trying to do something really significant and large. It's very difficult to do. They're doing it in an environment where economically it's really challenging. I think we're going to see a really powerful comeback soon. Again, that's up on a wider scale, especially since there's a lot more of these brands that are going to start dabbling in the world of offline retail. Will they dabble in it differently potentially? Are they more likely to use a service that sets up their first few stores as opposed to going it alone, or to try pop-ups potentially? But the idea that there's all is awry, I think is a misnomer.
Yeah, it's always an interesting topic because there's so many of them popping up every day of the week, and you wonder how many of them are going to succeed in terms of growing. And I've always said 9 out of 10 of them probably won't be able to do it. But the one that does it could be the next biggest thing ever. Anyway, this next question, Ethan, is one of my favorite topics, Kohls, which I've written a lot about. And I'm really rooting for them. And as you know, I've had incredible amount of challenges recently. So I'd like to get your take on, do you think there is ample reason for optimism there, and why?
So I was looking at Kohls a lot, especially as there was a lot of conversations about kind of activist investors trying to understand the situation. And there was clearly not the most positive outlook widely around Kohls. But every time I dove in, I couldn't help but walk away with a more optimistic conclusion than was kind of the standard. And there's a few reasons why. So the first is the big decisions that they've made in the last year and change feel really smart to me. So the decision with Sephora, to me, is one of the smartest decisions we've seen in retail in a while. If you look at every location that has a Sephora, it's outperforming the standard for Kohls. Overall, obviously, there could be specifics. If you look at this latest decision to have small format locations, to me, that's also really smart, and it's where retail's going. How do I widen the range of places I can be, reach my audience more effectively, be more efficient? All of that speaks to where retail is heading. So they feel really in line with how retail is evolving. And then I also look back at what was going on pre-pandemic. So from June 2019 until February 2020, there was consistent year-over-year growth. Obviously, that ended in March, and they haven't refound that footing since. But then I look at other brands that haven't refound that footing, and look at Old Navy. Old Navy was so strong pre-pandemic that we were saying, oh, they should spin off from Gap. Gap is holding them back. And now they're struggling much more. And so there is this sense that non-off-price, value-oriented apparel player, the supply chain challenges, all of these other issues, they just had a greater level of squeeze on those brands than others. And if that's the case, and we feel good about some of the longer term decisions that they're making, I have to go back to their brand carries a lot of weight. They're set up in really good environments in the suburbs. They're being smart about how they want to expand with more focused locations. And that leads me to think that the kind of we're overemphasizing a down period when the recovery is fairly right around the corner.
I would totally agree with you.
See, Robin, we like taking the same bold takes.
Yep. So we have some questions.
We do. Thank you, gentlemen.
Hi, Deborah.
Hi, guys. So we have questions that cover about as much terrain as you guys just did. So they're some strategic and some very operational. So one is, are extended hours for indoor malls or other stores a waste of SGA this holiday season?
I don't think so. I think it depends on when. So I don't know if we're going to see kind of that. I mean, I don't know. Maybe I missed these announcements, but I don't think we're going to see the same Black Friday rushes we saw in the past. I don't think Thanksgiving is going to be a thing the way it was in the past. But I think depending on weekends, like that Sunday visit for the mall that's open, if you have these extended hours of hanging out more, grabbing that meal, I think that could be really interesting. I think we need to I think retail in general is going to get more creative about where those extended periods are, because they won't be where they classically were. But that doesn't mean that they don't work in general. I wouldn't be so quick to sideline that strategy.
Got it. Thank you. Okay. So here's another operational question. In your luxury index, who did you include? And is there a way for you to comment, or can you comment on conversion? Visits may be lower, but the conversion rates may also have changed. Do you have any intel on that?
So this is something that we have a deep amount of anecdotal information on, and everything we've heard supports that point, which is that at least when we looked in other periods, so think April and May 2021, visits were down, but everything we were hearing was that sales were up because the visitor was coming with much higher intent. And we saw that, and that was kind of, from a thesis perspective, you have government stimulus, you don't have international travel, you don't have the same leisure activities available to spend on. So it felt like a lot more of the dollars were going there. am sure conversion rates are still higher. I also think it's a more competitive environment right now, not because more luxury brands, but because more things people can spend on. So I do think you are correct that conversions is a key element of this puzzle, and that's why you have to be, don't be kind of make a mistake like I did, and don't be too quick to write off what luxury can do. But I do think you need to take into consideration that the environment is just more difficult right now.
Okay. So back to holiday. Do you have any thoughts on the Macy's deal with Toys R Us? And good idea, bad idea? Is it going to enhance their holiday season? Just
I
any general
really like
thoughts?
it. I mean, I really like it. I think it's even from like we're thinking in a year that, forget long term, but in a year where we have this feeling like nostalgia is going to play a role. Again, we didn't get to have it last year. We definitely didn't get to have it 2 years ago. The bringing back Toys R Us, which is, I know if you're a millennial and older, Toys R Us was a big part of your childhood, of the process of so I do think that's a draw, and I think it's an added element of, hey, why should I go to Macy's and not somewhere else? Why should I go to the mall that has that Macy's at the entrance and not somewhere else? And it just allows you to accomplish more within that visit. So there are a lot of malls that don't have a great toy store in them, and this could help kind of offset the risk of that visit for some consumers. So I really like the idea. I think a lot of things Macy's are doing are really smart, and I think this is the next among of that list.
So sort of tangential to that, but also kind of weird, is so if you were a mall operator or heading Macy's or a big, department store chain or big box chain, do you think it would be smart to hire people from the theme park business, the theme park industry? You talk about experience and trying to create something that's a holistic, memorable experience worth traveling to. Is that a good place to mine retail and retail leaders?
It very well could be. I think the biggest problem with that we're not addressing with labor shortages is, why do people want to work for you? And it's interesting, and I say this coming from like the technology sector, where we suffer with the same problem. It's not that first of all, there's not enough people. Those people have tremendous they move very quickly, so they don't spend a lot of time in any one company. And I think we have to spend a lot of time thinking, why are we a great place to work? And so if I'm a retailer, I'm asking questions of, am I compensating people fairly? Am I giving them a good experience? Am I giving them a good workplace? Am I giving them growth opportunities? Because you can pull in the best people and they'll be there for a few weeks and then they'll decide this isn't for them anymore because they don't know what that long-term is. So I think we have foundational challenges to deal with here that were exacerbated by the wider economic kind of situation. It almost there was this light bulb moment for many people of, why am I doing this? Mm-hmm. And so I think the retail sector needs to ask, what do we do to better and make our place somewhere that you'd want to work no matter what sector you're from? Because you could have the best people come in from the world of theme parks, but if they want to leave a month later, you haven't really accomplished enough. You need to figure out a way to retain and build up professionals over time.
Fair point. So you've been talking a lot about behavior that's influenced very much what you've shared with us. The need for holistic benchmarks, which is like a whole different system of how you can compare and measure. But taking that into consideration, plus all this that we've gone through over the last couple of years, what advice would you give retailers for creating a new playbook to either predict or manage disruptions that are, at this point, becoming global? Maybe they have been in the past, but how would you do that? Does anybody have a playbook for this?
I think the answer is, I look at a Target and Walmart, others as really good examples of brands that are in the now, but also kind of thinking ahead. And that thinking ahead positions them well as things change. And even when we look at failures and struggles, short term, we see how those can actually benefit these brands in the long term. So think about Walmart purchasing Jet. When they did, it was this massive acquisition, multi-billion-dollar acquisition. How many of us are shopping on jet.com? The answer is none of us. But isn't Walmart so much better at online and e-commerce as a result of those acquisitions and the evolution they went through from those learnings? I think about, Amazon and Whole Foods. Do we think Amazon purchasing Whole Foods was the best thing for Whole Foods? Not necessarily. Do we think Amazon is going to be much smarter about grocery in the long run as a result? I think so. Think a look about Target buying Shipped, investing in curbside pickup and in their kind of distribution mechanism. That benefited them tremendously in the pandemic, though they were investing in it years before. And so I think the question that retailers need to be asking is, what challenges are fundamental to our success 5 to 10 years from now? And how do we start investing in those solutions now? So everything from what does an optimal retail fleet look like? What are the ways of maximizing a retail fleet? We're seeing so much emphasis on media networks within retail. This is a really important element. We think about online websites as kind of places to advertise and media networks. Why aren't we thinking about the store in the same way and asking how are there better ways for us to kind of drive revenue from the actual location? I think there's a whole, even what we were just talking about. How do I better build systems to compensate good employees fairly? So, we think about online. How many, I was on a panel right after the CEO of Allbirds, and one of the things he was saying at the end was an e-commerce visitor who had already visited a store was spending 150% of what someone who was going to e-commerce for the first time. So that store visit was driving a significant amount of value. Do we understand that? Do we know how to compensate our teams for creating that experience in a store, even if it only ends up happening online? Those are the types of questions that I think if retailers are grappling with them, even if they're failing in the short term, like they're trying something that didn't work, they're trying something else that's working a little bit better, that's the process you want to see. You want to see, Macy's 2 or 3 years ago was a brand we were really bullish on when some others weren't. And part of the reason was they were trying things. I don't know if at the time, we didn't know if Market by Macy's was the greatest decision ever. We didn't know if Backstage was the smartest thing they've ever done. But they were trying out concepts that made sense. It doesn't mean everything's going to work. But when you're in that mentality of testing and trying and innovating, you're going to land on good ideas.
Okay. Another question is about a sector that you haven't talked much about, which is beauty. Have you guys done any research and work on what's going on in the beauty retail sector?
The beauty industry has been one of the strongest, especially relatively. So certainly seeing the same challenges that everyone else is, but there is this longevity to their boost. And I think part of it is kind of this health and wellness trend, the creams, all the things about making ourselves feel better too. I think the return to work also gave it a boost. Even if it's not a full return, it's still something you need to, be stocking up on. So I think beauty has been something we've seen quite a lot of strength from, especially relative to other sectors. We do expect that to continue. I think just the consistency of that strength, part of the reason we didn't include it was like, it's just really impressive. Brands like Ulta, brands like Bath and Body Works, how consistent they've been, and how, Sephora too, and how they've been able to kind of drive visits and success.
Got it. So going back to monitoring stores, actual physical stores, what do you think is the future for all the empty storefronts all over the country, so this country particularly? And do you think it's a real estate problem, a rent problem, or do you think it's a consumer behavior lack of demand problem? And what's going to happen with all of this? They're in strip malls, they're in cities, they're everywhere. What's the story? So
I think there's a couple of things. So, we think about, and each environment is different. So we think about a major urban area and a business district, and you have an empty space there because people are worried about what the return to work looks like. And that space was so built on people coming in for work. Do we think it's going to come back? So I think that's an opportunity, because good, well-positioned areas in major cities, at least in my opinion, are going to retain their value in the longer term, even if they've seen this hit in the shorter term. There's other areas that are going to struggle more, right? Just because there's a downturn. So areas that are feeling like maybe a bubble did burst. So think like a San Francisco. It was just too much. Like people were spending too much to live there. The rents were too high. There was no way that was sustainable. And so when they had the opportunity to leave, they were going to do so. And that doesn't mean the city's, dying, but it does mean that it's likely correcting. I think when you think about like strip centers, there's a lot of question for the landlord to ask about, like, what is the experience I'm providing? Who are the people who might be interested in a location here that weren't before. And I think there's a tremendous amount of opportunity. So the suburbs are more exciting than they've been in the past. We have more retailers thinking about, hey, I'd like to be in the suburbs. I'm willing to try out different formats to get there. Apropos what we said about Kohls, they're testing out different store formats so they can reach different audiences more effectively. But I think there's also a really interesting phenomenon happening at that top tier of shopping centers and malls, which is those locations are focusing less on retail, and they're focusing more on experience-oriented tenants, more on health tenants, more on food and beverage. So as a result, there are some players who used to be in those top tier malls who now don't have a space in them. So they have to look for somewhere else. And so those strong B malls, that shopping center that they might not have considered but nearby, but has a similar trade area to that top tier mall, is there value there? I think the answer is yes. And it's obviously on a location by location basis, but I do think we're going to see this waterfall effect from a tighter focus at some of the top centers in the country across the board to actually bring value to that next segment of the retail landscape.
Well, I hope you're right, but I would say Third Avenue and Broadway in New York City could surely use some significant help, because those are our strip malls, I mean, our strip centers in a way, and they're all completely, many of them storefronts are completely deserted. So there are two last questions, very different ones. Do you think the consumer behavior has been permanently changed by Amazon's influence on us to want everything immediately? Do you think that trend's reversible? Should it reverse? It has put so much pressure on so many retailers.
Partially. So there's no going back. We expect certain things fast, but we also are price sensitive. So as costs of delivery go up, and as we get charged for the delivery, there's going to be a little bit of pullback. I think probably we saw a pendulum swing from everything was in the store to now everything's delivered to now we're somewhere in the middle.
Mm-hmm.
And that's probably where we'll sit. I do think we're going to have a healthier retailer customer relationship between what are the real costs that I need to pay in order to have delivery, and especially immediate. And so I think things have changed forever. I don't think they're as extreme as they maybe were at their peak. By the way, that's because it's not good for the retailer, and therefore it's not good for the consumer if they're going to have to swallow that cost. So even the returns and the like, and it's something we talk about a lot. You've done some really great reporting on it on the Robin Report of how expensive it is to have those returns when you're kind of returning them not to a store. So I think a new balance is going to be found. We've definitely changed forever, but not necessarily all the way.
Okay, we'll see. Okay, so the last question is kind of a big one, existential to some extent. So if you think about natural selection and the numbers of things that can survive, what do you think the critical mass of the number of retail stores that should even be in business? I mean, is this just an exponential open end, or is there a natural balance where we've just, as Robin writes about all the time, overstored, completely overstored? How do you bring it back to some kind of sustainable balance?
I think the first step is to stop thinking about real estate with a pure retail, residential, office breakdown, and to start thinking about what belongs in a space that lifts up the entire space. So co-working spaces in malls are a great example of that. Health tenants in malls are a great example of that. But why not a co-working space in a major shopping center that gets a lot of traffic? If I'm running an office in New York City and in Stamford, Connecticut, which is on that train line, people are only coming in 2 or 3 days a week. I can set up a co-working space there. Isn't that going to benefit the Starbucks that's in that center? Couldn't that benefit the CVS that's there? So I think we're starting to think differently about what belongs in specific spaces. And as we think differently about what belongs in those spaces, we're going to be able to maximize space while still being less retail, because there's other types of tenants that can fill those spaces more effectively, create more diversity. Even the digitally native brands we spoke about. We're seeing this trend of less companies that have 1,000+ locations and more that have 50 to 200. That greater level of diversity, I think, is going to be very positive for real estate as well.
Well, that ties it all up nicely. It makes me wonder though. It makes me wonder though if we have to redefine what retail is and what it means.
100%.
Well, that's a great topic.
Our next one.
Yeah.
So thank you.
is that a wrap, Deborah? I think it is,
It's a wrap
right?
from my perspective. Thank you
Well,
so
let me,
much.
let me tell Ethan that once again, Ethan, we're honored to have you. I mean, you add so much value to the Robin Report. And boy, I agree with you on most of the topics, but I also always learn more and more from you.
Thank you.
And I want to thank our audience for tuning in. And I am sure that they learned an awful lot as well. So thanks once again, Ethan.
And good questions.
Thank
They had
you.
great
Yes,
questions.
exactly.
So thank you.
Thank you.
Take care.